You know, sometimes I wonder if there's a company out there like quietly pulling the strings of the global economy.
Hmm.
And honestly, Moody's might be it.
Yeah,
Here they are.
they're a powerful force
They are.
in the financial world.
So today, we're diving into their latest earnings call,
Okay.
specifically their record-breaking third quarter. But here's the twist.
Okay.
Is this really a sign of strength?
Hmm.
Or could it be a red flag in disguise?
Ah, yes. The age-old question, right? Do those impressive numbers tell the whole story? That's what we're going to unpack today.
Okay, so Moody's reported their highest ever revenue for a third quarter,
Yeah.
a 23% jump.
Wow.
What is driving that kind of growth?
Two main factors.
Right.
First, there's been a huge surge in companies issuing debt.
Right.
It's like a giant borrowing spree.
Okay.
And that means big business for Moody's.
Right, because they're the ones who rate all that debt.
Exactly.
Essentially giving it a grade that investors use to decide whether to buy it or not.
Precisely. It's like a credit score, but for giant corporations.
Mm-hmm.
And just like you want a good credit score to get a loan with a decent interest rate,
Right.
companies need good ratings from Moody's.
So more borrowing means more work for Moody's, which means more revenue.
Yep.
But doesn't this also mean that companies are taking on a lot of debt?
That's right.
Isn't that risky?
That's the big question. On the one hand, it suggests companies are confident about the future
Okay.
and eager to invest.
Okay.
But as Moody's themselves pointed out,
Yeah.
it could signal trouble down the line if those companies borrowed too much too quickly.
Right, like loading up your credit card for a shopping spree.
Yes.
Fun in the moment, but potentially painful later on.
Exactly. And here's where it gets even more interesting.
Yeah.
Moody's used the term pull forward to describe some of this borrowing.
Okay.
It basically means companies are rushing to issue debt in now W
Okay.
because they're worried things might change later.
What kind of changes are they worried about?
Well, think about it.
Yeah.
We've got an election coming up,
Right.
which always creates some uncertainty in the markets.
Sure.
Plus, there's been talk of potential interest rate hikes next year.
Uh-huh.
Companies might be thinking, let's lock in lower rates now while we still can,
Right.
even if it means taking on more debt than we might have otherwise.
I see. So they're trying to get ahead of the curve, even if it means taking on a bit more risk.
And what's fascinating is how this pull forward phenomenon played out differently for different types of companies.
Okay.
On the call, Moody's drew a distinction between investment grade and speculative grade companies.
Okay. Remind me again what those terms mean.
Sure.
It's like the difference between a reliable borrower and, well, someone a bit more of a wild card.
That's a great way to put it. Investment grade companies are those seen as the most stable and reliable borrowers.
Right.
Your blue chip companies with solid track records.
Okay.
Speculative grade companies, on the other hand, are considered riskier bets.
Yeah.
They might be smaller, newer companies,
Right.
or those in industries that are more volatile or prone to booms and busts.
And what did Moody say about how these two groups were behaving? I have a feeling it's going to get really interesting.
You're right about that. It turns out that speculative grade companies were the ones who really front-loaded their borrowing this year.
Wow.
Much more so than usual.
Wow. That's a bold move.
It is.
What does that tell you?
It suggests they're a bit nervous about what lies ahead.
Okay.
They're willing to take on more debt, even at potentially higher interest rates, because they're worried about what might happen if they wait.
Yeah.
It's like they're battening down the hatches, preparing for a potential storm.
So while the overall surge in borrowing is good news for Moody's bottom line,
Right.
this rush to borrow by speculative greed companies, that could be a sign of some underlying anxiety in the market.
Precisely. And that leads us to another intriguing trend. Moody's highlighted the rise of private credit.
Okay.
This one's a bit more complex,
Mm-hmm.
but it has the potential to fundamentally reshape how companies access capital.
Okay, I'll admit private credit sounds a bit intimidating.
Yeah.
Can you break it down for us?
Imagine a world where instead of going to a bank for a loan,
Yeah.
you went directly to a giant investment firm.
Okay.
That's essentially what private credit is all about.
Interesting. So it's like cutting out the middleman. No more stuffy bank loans.
In a way, yes.
Yeah.
And Moody's sees this as a huge E opportunity.
Okay.
They even hinted that traditional credit ratings might become a part of this new world of private credit.
Wow. So instead of just rating loans from banks,
Right.
they'd be rating loans between, say, a tech startup and a private equity firm.
Exactly. It's like they're trying to position themselves as the trusted assessors
Yeah.
in this whole new financial landscape.
Yeah.
But that raises the question, If private credit really does take off, could it eventually disrupt the traditional banking system as we know it?
That's a big question. It'll be fascinating to see how that all shakes out. But for Moody's, it seems like they're hedging their bets, embracing the changes, while also doubling down on their core business.
Absolutely. And speaking of hedging their bets, they're not putting all their eggs in one basket. Remember, Moody's isn't just about rating debt. They've got a whole other side to their business that's quietly booming Moody's Analytics.
Right. They spend a good chunk of the earnings call talking about that, and honestly, it flew a bit under the radar amidst all the debt talk. But it's actually a fascinating part of what they do.
It really is. Think of it this way. If Moody's ratings were like giving a company a financial report card, Moody's Analytics is like providing the tutoring and study guides to help them ace the next one. They're giving businesses the tools and insights to make smarter decisions.
Okay, I like that analogy. So instead of just saying, you have a B plus in financial health, they're saying, here's how you can get an A.
Precisely. And they're doing it with data.
Mm-hmm.
On the call, they highlighted their decision solutions products, particularly for banks and insurance companies.
They specifically called out something called KYC, Know Your Customer. That sounds a little ominous, like something out of a spy movie.
It does have a bit of a cloak and dagger ring to it, but it's actually all about helping businesses avoid doing business with the wrong people. Think criminals, money launderers, that sort of thing.
Ah, so it's about compliance and security in a world where financial crime is increasingly sophisticated.
Exactly. And with all the headlines about data breaches and financial scandals, it's no surprise that businesses are willing to pay for tools that can help them stay on the right side of the law and protect their reputations.
Makes sense. But it wasn't all just algorithms and risk assessments. They also talked about something called research and insights, which sounds a bit more human.
Yes. This is where their team of expert analysts comes in. They dig deep into economic trends, industry data, even geopolitical events to provide clients with a nuanced understanding of what's happening in the world and what it all means for their business.
So it's like having a team of super smart analysts on call, ready to answer any question you might have about the global economy.
Essentially.
Yeah.
And they're using some pretty cool technology to do it, too. Remember we were talking about AI earlier? Well, they're using it to power a new research assistant tool that helps clients cut through the noise and find the information they need fast.
That sounds incredibly useful, especially in today's world of information overload. But if I'm hearing you correctly, it seems like Moody's Analytics is firing on all cylinders, so why isn't everyone using it?
Well, some are, and they're seeing great success.
Yeah.
But you're right, adoption isn't happening overnight, especially with larger, more established companies like big banks.
Why is that?
It's a combination of factors. Big institutions tend to be more risk-averse. They've got complex systems and regulations to navigate, and they don't want to rock the boat unless they're absolutely sure a new tool is worth the investment.
That's fair. But it does seem like Moody's Analytics has huge potential, even if it's a slower burn compared to the more immediate revenue from their credit rating business.
Agreed. And speaking of potential, we can't forget about the elephant in the room, RMS. Remember that massive acquisition they made a few years back?
How could I forget? $2 billion. It was supposed to be their big foray into climate risk.
Well, exactly.
Yeah.
And on this call, 3 years later, there were a lot of eyes and ears on how that gamble is playing out.
$2 billion is a big bet, no doubt.
Mm-hmm.
So 3 years and countless climate reports later, is RMS living up to the hype?
It's been an interesting journey, that's for sure.
Mm-hmm.
Remember when Moody's bought RMS? They were really looking to achieve two things.
Okay.
First, they wanted to bolster their presence in the insurance world,
Uh-huh.
especially when it comes to those big, scary risks.
Right.
Hurricanes, earthquakes, wildfires.
Yeah.
The kind of things that keep insurance CEOs up at night.
Right, because if you can accurately predict those events, you can price your insurance policies accordingly and potentially make a lot of money.
Exactly. And the second thing Moody's wanted was to tap into RMS's expertise in climate and catastrophe modeling.
Okay.
This wasn't just about selling more insurance products.
Right.
They saw it as a way to provide valuable insights to a much wider range of businesses.
Okay, so how's that part panning out? Are banks and businesses actually using climate models in their day-to-day decisions?
They're starting to, and that's where things get really interesting. Think about it this way.
Okay.
If you're a bank thinking about lending millions to a real estate developer,
Right.
building a luxury condo on the coast,
Yeah.
you need to factor in the risk that rising sea levels could put that investment underwater literally in a few years.
It's no longer just about whether the developer can repay the loan. It's about whether the collateral itself will even exist in 10 years.
Climate risk is financial risk.
You got it. And that's the message Moody's is trying to drive home.
Yeah,
They're betting that by integrating these climate models into their existing offerings, they can become indispensable to anyone who needs to understand these emerging risks,
right.
whether it's a bank, a corporation, or even a government agency.
It's like they're saying, forget crystal balls, we've got climate models.
Something like that. So stepping back from all the numbers and technical jargon, what's the big takeaway for our listener? What does it all mean?
The world of finance is changing, and fast.
Mm.
We're seeing a surge in corporate debt,
Right.
potentially fueled by anxiety about the future.
Yeah.
We're seeing new ways of lending and borrowing emerging with private credit.
Uh-huh.
And perhaps most importantly, we're seeing climate change reshape how we think about risk and investment.
And in the middle of all this, you've got Moody's trying to navigate these shifting sands, not just by keeping up, but by staying one step ahead.
Exactly. And that raises one final provocative thought that wasn't explicitly addressed on the call.
Okay.
What if all of this, the rise of private credit, the increasing focus on climate risk, what if it fundamentally changes the very notion of a credit rating?
Yeah.
What if in the future it's not just about assigning a letter grade,
Right.
but about providing a much more nuanced, dynamic, and personalized assessment of risk?
It's like moving from a snapshot to a high-definition video stream, constantly updating, constantly evolving.
Precisely. Yeah. And that's the future Moody's seems to be building towards.
It's a future full of possibilities and maybe a few more billion-dollar bets along the way. Thanks for joining us for another deep dive. It was fascinating to unravel this one together.
Until next time.